Federal Reserve discounting, the window they don't want you to look into. Behind every major loan and commercial transaction lies a secret access point, the Federal Reserve discount window. It's how banks turn your signature into liquidity. But what if you could see what they don't want you to know? The Federal Reserve discount window is perhaps the most underexamined pillar of the modern monetary system. Its purpose, in formal terms, is to provide short-term liquidity to depository institutions via collateralized lending. In reality, it is a back-end monetization pipeline where banks convert private negotiable instruments into public legal tender, quietly, quickly, and without scrutiny. Under 12 U.S.C. Section 412, the Federal Reserve is authorized to issue Federal Reserve notes in exchange for eligible paper. What qualifies as eligible paper? The statute includes notes, drafts, bills of exchange, or bankers' acceptances, the very same instruments consumers generate daily when they apply for credit cards, auto loans, mortgages, or use POS systems. When a borrower signs a promissory note, often unknowingly with a blank endorsement, the receiving institution may use that note as collateral security to request Federal Reserve notes. This process is known as discounting. The bank doesn't use its own money. It uses yours, issued from the borrower's signature, to access freshly minted credit from the Federal. This is facilitated via the Operating Circular No. 10, OC 10, a legal agreement submitted by financial institutions to gain access to the discount window. Once approved, the institution has a standing relationship to pledge and swap notes for reserve credit on demand. The submitted note, your promise to pay, becomes the asset. The bank becomes merely the intermediary, profiting from the spread between what it receives and what it reissues as debt to the borrower. Most consumers are never informed of this double-entry monetization, nor that they've already discharged the debt through the issuance of their own collateral security. In short, you funded the loan. Footnote: this section reveals how banks use consumer-signed notes to obtain Federal Reserve credit through the discount window, turning the borrower into an unknowing creditor.